think Basel III would actually be good for the capital markets. I think it's easy to see it prima facie and just say we're bad, but the truth is, I think it'll be good. Now, the whole idea is that under Basel III, banks are expected to have better quality assets, effectively, right? So, and there's some sort of like correlation between the quality of your assets and the kind of, the size of capital that you hold. Now, the truth of the matter is, what it would mean is banks will probably be more interested for the first time, instead of creating loans, which are what I would call illiquid assets, actually interested in, say, for instance, buying bonds. You see what I'm saying? So by actually saying, okay, issuing houses, you create bonds, which we can now buy and put on our balance sheet, okay? That could help them lengthen the curve, right? So it could, in a way, mitigate some of the things that my colleague Balaji was talking about, whereby, you'd have, when you look at a bank's balance sheet, you see a lot more securities, probably, than, say, what I would call loans, per se. So that's a possibility. And because they're rated, it's easy to quantify the risk. Okay? So it might actually end up being something that's good, as opposed to something that's bad for the market. The funding of infrastructure will not thrive in this economy until we take a different approach to our monetary policy. Okay? The economics of funding a bridge at 25%, okay, is fundamentally different to the economics of funding a bridge at 6 or 5.5%. Okay? A 5.5% funded bridge is a lot more affordable and makes more economic sense than a 25% exactly. And until we're able to find a way to understand, and this is where my issues come in, is that I've always been a strong believer that our inflation is cost push. I've been talking about this for years and years on end. And I believe that whatever funding we need to be doing, all right, whatever thrust we need to be doing has to be pushing or finding a way, okay, to reduce the cost of producing in the country. The factors of production have to drop. When you're able to bring down factors of production, it now makes what you're trying to, in other words, let me give an example. Food inflation is probably the biggest component of our inflation. Am I right? Now, one of the reasons why we have that is because we don't store. And we don't store because we don't have power, right? And because we don't, most of what we produce is thrown down the river, okay? Because they're perishable. And I ask a very simple question. Can you imagine if one of the things we did was to basically fund silos across the entire country, powered by solar, such that we're able to store food? What do you think would happen to food inflation? Do you think it will come down? It would. Now, if it did come down, that has an impact on inflation, which means that the fight against it with high interest can be moderated, making the cost of actually funding, right, infrastructure a lot more accessible, and also ensuring that funds move from what is predominantly known as government securities today, okay, to more diversified pool of asset class. Obviously, the governor of the central bank has many reasons why, not just the governor, but also the MPC, the committee, have many reasons why they retain and continue to keep interest rates where they do, and keep the monetary policy as tight as it is. I'm sure they have major reasons, and a lot of times we're not even seeing what they see. You know what I mean? But if you ask me fundamentally, I think there are things that can be done, at that level to actually begin to drive down, those key things that are actually keeping our inflation high. So the example I gave in terms of food is that, yes, we don't have power, but there are alternative sources of power. It might be sort of, there's a cost to it, there's no question about it. But, some of the things that we do with these funds could be, for instance, to create a fund to support silos, such that basically when food is grown and produced, we can do what? We can store it. And because we're using solar power, right, it can store, thereby increasing the quantum of food in the system, and therefore ensuring that the prices of food is less volatile. that could have a positive impact on inflation, and therefore give some of the impetus for monetary policy to say, okay, we can ease cost of funding. Because the truth of the matter is, to really diversify the economy, we need money to go into it, and that cost has to be economically viable.